need our own gold markets. We can't rely on this system, that the UK and the US have set up.
Yeah, I think that's sage advice, and I think again that's pretty much how we end all our shows. Is like, how much physical do you have? Because I think you're talking about the exchangeability. When people realise that there's an exchangeability between a COMEX, undeliverable COMEX position, and GLD COMEX position and an SLV position, and it's just exchangeable. So really, all you're doing is shuffling paper credit, and nothing meets the road at this point. And as you say, they make it really onerous, and the average person, as you say, cannot go to an authorized participant and take delivery. Nor would you. Why would you even go through that process? It's clearly it's ring fenced, because if I want to take delivery and I have a COMEX position, I'll EFP it, I'll put it into the spot market. Yeah, I'm going to have to pay a premium. And in fact, the more size I want, the bigger the premium. But essentially, I can then spot index that position in the spot market and make sure it doesn't have to go anywhere near GLD. And then we can then go through the T+2 delivery process. And one of the beautiful things about, which doesn't appear to be the case if you look at the charts, but it is the case, is that, as we say, once you then take that position and you spot index it into the spot market, into the XAU market, which is the XAU cross between the dollar, XAU cross between the euro, whatever it is, but essentially it's a foreign exchange cross. You're now saying, I turn around to the liquidity provider, and in March 2020, when people turned around to the liquidity provider and said, just give it to me, okay? I can't get the physical. The Swiss refiners are on COVID lockdown, can't get my usual sources. Okay, you've just provided credit, I'll take it. And then, of course, we saw $85, $100 spreads as the liquidity providers have bailed out to find short cover in the COMEX, and of course the spreads rose and they got rinsed, and like 200 million lost by Goldman Sachs, and of course all those guys got bailed out, but not the small second tier banks, Swiss banks that we deal with. They were suck it up. In fact, a lot of them exited that space directly afterwards. So I guess the point I'm trying to make here is that when you do that, when you actually do EFP it, now there is an ability to take a physical product. So this is an interesting time. What do you think?
Yeah, I agree with you. I do think we're starting to see, Andrew, the premiums blow out between, what the retail people can get and what you see on the spot price. And I think also, in addition, and you kind of alluded to this, we're seeing an arbitrage opportunity between markets with the NFP, or I'm sorry, the EFP, the exchange for physical, between the UK and the US. But there's a couple of new players in the town, Andy, China, the Shanghai, which is a much higher physically delivered market. And if you look at Shanghai gold prices, they're much higher than what we have in the Western markets. And so in the Asian trade, through physical trade, you see more accurate price discovery of what gold should be valued at and silver should be valued at. But now they're starting to compete with the Western markets. And then you had France recently decide to reopen their gold trading business. So they have established vaults, and they spent millions of dollars rehabbing all their old vaults that they used to store gold in. They have developed software in order to get on these exchanges and trade. So you're starting to see the rest of the world kind of clue into the fact that we need our own gold markets. We can't rely on this system, that the UK and the US have set up. And there are now alternatives. And you're starting to see some dissension among these markets as to what the price could be. There's a lot of infighting. And if you look at the charts, they're all different. So there's not consensus over what gold's valued at. And it does make money for the people that want to run the ARBs, if you want to play the ARB between two different markets. But it's not legit. We're still not at the point where we have legitimate price discovery. And I think in a nutshell, that presents a lot of risk to the banks. The four big banks that I mentioned that run the derivative markets, and specifically the precious metals ones, if they lose control, Andy, they're in trouble. Because their scheme will be exposed for not having enough physical backing, not only now, but at all times in the past. What would that do to the confidence in, those markets? They would collapse and people would move to these other markets. So, as you mentioned, there are short-term opportunities to do arbitration and prices like the EFP, but people are looking for physical, So they'll use the EFP for physical. They'll use COMEX delivery for physical. They'll go and buy it from the miners. That's happening more and more. And it's not just the central banks buying gold and silver. It's a lot of other people looking for gold and silver. It's interesting. There was a report out last year that the refiners who refine into the bars that go into like London Good Delivery or any of these markets couldn't get enough silver and gold from the miners. So they were actually buying it from people that would have brought it to the exchange. So we're now at the point where there's not enough physical production, specifically of silver, but also of gold, that meets current physical demand. And you're starting to see signs of that across the market as well. So in other words, to edify your point, however people can get to physical, they're already starting to do that. And eventually these derivative products that we talk about are going to be realized for what they are, which were synthetic and never real. We never had the right prices, and we're gonna figure out what the prices are. That process is underway.